So
So here we have Mr. Damon Silvers from the AFL CIO at an antitrust conference here at the National Press Club. Mr. Silvers, what do you think, please describe your position in the AFL CIO, and what is the impact of major mergers as a union?
Well, I'm the policy director of the AFL CIO, and that means I think about public policy on behalf of the labor movement. Large mergers and concentration raise a bunch of issues. They potentially they cut both ways. They sometimes make it possible for firms that are really focused on sometimes they make it possible for firms that really have long-term focus and are devoting real resources to improving human capital and doing other things that make sense for workers. Sometimes they help strengthen those firms. Other times they're a way of essentially accumulating power that can be used both against consumers and against workers. What I was talking about at this conference was that a public policy approach to antitrust that recognizes that the concentration of corporate power is about more than consumer pricing is really important if we're going to have a society in which workers' voices can be heard.
So you were on the panel, the Congressional Oversight Panel on the Dodd-Frank during the whole financial crisis, where the issue was too big to fail. Now with mergers, are these companies too big to manage? Are they just too big?
From an investor perspective, and workers invest in public corporations through pension funds and through their savings. From an investor perspective, and also sort of from a public interest perspective, it's undoubtedly true that we've seen firms get too big to manage, where sort of basic, particularly in the financial sector, where basic risk management functions just don't work. I'm pretty convinced that based on the conversations I've had with senior management at the time, that in the years running up to the crisis, that Citigroup had reached that point. That people who were ultimately responsible, the CEO, the board, for basic risk management, did not understand the risks that people were taking in the mortgage market in that firm. So that's a real risk. It's a real thing.
I mean, are you opposed? I mean, we see the Dow Chemical merger with DuPont. People are saying that's too big to manage, that they're only doing it because of the low-cost money that we have in the market after the failure of 2008. There's too much money out there. People are doing mega mergers, like the Microsoft LinkedIn would only happen because there's too much free cash. Is this something that the union at AFL-CIO could do or would like to do, activate, to sort of block these mergers for merger's sake?
We've taken positions on mergers at various times in the past. We do so, generally working with our affiliates our affiliated unions that represent workers at the firms involved. A lot of different considerations go into that kind of thing. The impact on our members as consumers, as investors, as workers, I think we've taken positions sometimes. I think we'll continue to do so.
Okay, the last question is also, it was an interesting situation where after the bankruptcy of General Motors, the United Auto Workers became shareholders in General Motors. And we should really help bring General Motors back to life, but the UAW seemed to be very uncomfortable. But do you think that union members will become board members and investors, shareholders in listed companies, as we saw with the General Motors? Is that a one-time deal, or are we going to see more of that? That's sort of European. And
yes. Well, as you know, in Europe, having workers on the boards of public companies is routine. It's the standard way of corporate governance in Germany and Scandinavia and other parts of Europe. In the United States, it's generally happened as a result of restructurings. You mentioned the example of the United Auto Workers, where a healthcare fund that was sort of that the UAW had a role in was a large shareholder in GM and Chrysler. A number of companies in steel and other basic industries have representatives of their workers' unions on their boards today. So it's not the auto example is not the only case. But it's not standard today in corporate America. There are many people in the labor movement who feel, and now I think increasingly in the general public as a result of things like short-termism and runaway CEO pay, there's a lot of voices saying, well, maybe our corporations would have more of a long-term orientation if there was more worker voice in boards. And the labor movement is certainly open to that. But as of today, that practice is not unique. It's not rare, but it's not the default here in the United States, the way they say in Germany.
Okay, thank you, sir.
Thank you.